Howdy, Team 42. It's your skipper here, Darius Dell, to present our Around the Horn Weekly for Saturday, August 14th, 2021. As always, we have a lot of content to get through, so let's just hop right into it, starting with slide 3 on the key takeaways. Goldilocks returns as the dominant market regime, with 14 confirming asset market volatility adjusted momentum signals, contributing to its 32% modal outcome share of the total. Are we in the early innings of a broadening rally in the equity and credit markets? Most likely. Our U.S. equity sector and style factor Sharpe ratio dispersion analysis displayed the presence of 4 cyclical sectors and style factors in the upper quintile of our 50 exposure sample for the first time in almost 2 months. You have materials in there, financials, U.S. with EM exposure, and then least shorted high beta. We're also observing a small but growing compendium of defensive exposures in the lower quintile as well. We have most shorted growth, Amazon, Netflix, most shorted low beta, and most shorted low debt. Our crowding analysis, which tracks the relationship between 30-day at-the-money put implied volatility and our proxy for the local realized volatility regime, continues to demonstrate a buy-side consensus that is extremely worried about further weakness in recent market leaders, specifically the exposures within the mega cap quality growth style factor complex and the traditional equity bond proxies like utilities and consumer staples. To the extent market participants increasingly adopt our transitory view of inflation via keeping long-term interest rates in a manageable range over the next few months, we could see a decent chunk of that eyeball premium catalyze short covering of hedges across the dealer community. In terms of what's coming down the pike in fiscal policy in DC, there are a number of important catalysts for asset markets that digest over the next few months. Or ignore rather, because you still got $120 billion a month of QE. But the bull case on all the fiscal policy dynamics is that the 3.5 trillion budget resolution is haircut by only 500 to 750 billion, and the government narrowly avoids a shutdown at the last minute, and the lack of fresh treasury supply stemming from Treasury Secretary Yellen's extraordinary measures to keep the government financed is a positive for risk assets from a net liquidity perspective in terms of the amount of money that the Fed is buying, amount of bonds the Fed is buying relative to the amount of debt the Treasury is issuing. The bear case is that the government shuts down at the end of September and the $3.5 trillion plan is haircut by 1 to 1.75 trillion, which is the upper limit of that is actually the number amount of that plan is actually going to be financed by debt. So you can obviously see some even conservative Democrats having a problem with that. But anyway, as of now, we're inclined to lean more towards the bull case, although we're not necessarily at either extreme. Obviously, the bull case is extremely bullish. The bear case is quite bearish, but we're close to the median, but we're leaning towards the bull case there. But all told, in the context of everything I just highlighted, we're content to maintain our current hybrid Goldilocks / deflation portfolio construction and its associated exposures, which we believe is well positioned to handle the transition back to a more sanguine market environment. Next slide here. So looking at slide 4, looking at our current portfolio construction, again, no changes this week. We think we're well equipped for a broadening Goldilocks rally in risk, fueled primarily by liquidity, but also by the fact that historically speaking, going back to the great asset market backtest that we highlighted on Tuesday's August scouting report, when the economy and inflation slow down at a modest pace, historically, that's been very positive for asset markets because it obviously implies the Fed can take its time with respect to removing liquidity from the system. On slide 5, looking at our global macro risk matrix, as always, every week with these videos, we try to look at how we ended the week in terms of further setup next week. And, just not a lot of changes on Friday, but in terms of what happened on Thursday, you had the DAX and the Euro Stock 600 break back to bullish. Copper broke back to bearish. We'll see if that holds. Bloomberg Galaxy Crypto Index broke the bullish. Again, this follows last week's, so going back the first week of August, you had Bitcoin break back to neutral on Friday. You had Ethereum break to bullish. Obviously, on Saturday, we added Ethereum last week alongside Ireland. So, obviously, a continuation of that. On slide 6, looking at our global macro risk matrix, the market regime signals and the probabilities. As I highlighted, Goldilocks has once again became the modal outcome from a probability perspective. So it's now the dominant market regime again, as we've presaged, throughout our notes over the past few weeks. We said, hey, we think, obviously inflation and deflation are having a fist fight over who wants to be the modal outcome, but we always thought that would be a head fake, just given a lot of our views on the forward-looking outlook for both growth and inflation and policy. So looking at slide 7, so dominant market regime, we got a green bar, very narrow green bar, but we do believe that narrow green bar could turn out to be a widening green bar over the next few months on slide 7. On slide 8, looking at positioning through the lens of the CFTC Commitment and Traders Report. So we had a bearish capitulation in gold. So you look at the gold line down there. We had minus 35,000 contracts come out of it on a week-over-week basis. That delta is on a 1-year Z-score basis. That delta is a -2. Historically speaking, you got about a +2% positive 3-week forward performance whenever you see that signal trigger. So obviously looking for gold to rebound over the next few weeks. It's obviously had a big rebound since Monday's capitulation lows, which this data does encapsulate. On slide 9, looking at our crowding and dispersion analysis. So as I mentioned, there's a ton of eyeball premium. There's been a ton of eyeball premium in the market for the last couple of months. Investors are extremely nervous. They're very concerned about the removal of Fed liquidity. They're obviously concerned about the increasing likelihood that we get some disappointing catalysts out of fiscal policy as well. And so you're seeing that show up in the options market. Well, what happens when that stuff doesn't turn out to be bearish? Well, guess what? Those hedges have to be covered across the dealer community, and that's how you get markets to grind higher in a broadening risk rally, which is something we've obviously been talking about for the past couple of months, past few weeks in the context of the deflation-inflation debate. So as I mentioned, you still got a lot of eyeball premium in the sort of mega cap quality growth style factor complex, but even like high beta over there to the right side of the y-axis. Whenever you see an eyeball premium on top of an already decent amount of realized volatility, that's when people are crowding into short. So this is how you can get the short squeeze that catalyzes a more doable rally. I guess the jury's still out. The jury's always still out every time we do one of these videos, every time we put out the pen to paper with respect to our research views. It's all ex ante. We don't know the outcome. We are just positioning ourselves from a probability perspective. But again, it's likely that, again, just based on the composition of this slide alone, it suggested that you could actually see a broadening rally in risk, which is exactly what I think we saw throughout the most of the week. Looking at the dispersion analysis. So as always, we always try to identify which sectors and style factors are leading versus lagging. Again, there's 50 total sectors, so you're only seeing the upper quintile and the lower quintile in this chart. But the reason I windsorize that sample to the upper and lower quintiles because it allows you to see what grid regime the market is betting on. And at the margin, obviously we've been talking about this for months. It's been 2 consecutive months of deflation from a sector and style factor leadership perspective. Cyclicals at the bottom, defenses at the top. Well, now you're starting to see the emergence of cyclical sectors and style factors like materials, USA with the EM exposure, these shorted high beta, and then you obviously have financials in there as well. So to me, the presence of these sectors, kind of creeping into the upper quintile, and obviously we look at Sharpe ratios because we believe that's a better proxy for flows than actual price changes. Price changes, any one snapshot of price change, you don't really have that volatility aspect that tends to trick people at times. But we look at Sharpe ratios to identify, hey, if something has a high Sharpe, it probably means there's a lot of flows pouring into it, or if it's a very low Sharpe, it means there's a lot of persistent selling pressure flowing out of it. So I did want to call that out because, again, it speaks to the broadening, the likelihood of a broadening risk rally in the equity and credit markets. On slide 10, just highlighting, hey, this is why we look at the dispersion analysis the way we do. Just wanted to remind people that this is how exactly, this is what I'm thinking of when I look at that dispersion slide. On slide 11, kind of getting into the wood here. So the S&P 500, that's still bullish VAMS, is more downside than upside heading into next week. Looking at WTI, that's back to neutral VAMS. It's a lot closer to the lower end of its probable range, but one thing I would call out is that its probable range is now sloping downward. So are we on the precipice of a breakdown in crude oil? I don't think so. It's unlikely given the bottom-up macro regime environment that we have highlighted. But again, everything is ex ante. We're going to react to the changing signals as they develop. On slide 12, the U.S. dollar is still maddeningly neutral. This is why you haven't seen a big move in break-evens and inflation expectations. You haven't seen an enormous unconsolidation of commodities in general, because again, the dollar's been in a very narrow, tight range for the past couple of months and really all year, taking its turn going up and going down, but that range has been extremely narrow, but it's a lot closer to the lower end of its probable range. So you could see a dollar bounce and some deflation pressure, certainly as we develop later into the week, next week. On slide 13, looking at the nominal 10-year. So not so fast, my friends, as my buddy Lee Corso likes to say. from College Game Day. For all you folks out there who are probably not American and don't watch college football, I realize that. Go Google Lee Corso. It's still bearish VAMS, high yield OAS. It's back to neutral VAMS. We expect them to reside in the neutral VAMS territory for a while. It's very unlikely you see a breakdown to new lows in credit spreads in the context of a decelerating economic environment. But that doesn't mean they need to break out and go from, I don't know, let's say 330 over, 340 over to 500 over. We don't have that kind of economic slowdown baked into the cake in terms of our, bottom-up macro regime projections and all the models and data that we use to get to those conclusions. So it's very likely you could stay in this neutral VAMS range from a high yield OAS option adjusted spread perspective for a little bit, but that doesn't necessarily exclude asset markets and equity and credit markets from actually trading higher. On slide 14, the high beta, low beta ratio. So looking at some of these ratios as a proxy for the kind of risk that asset markets are taking or want to take. Not so fast, my friends, in terms of the broadening rally. It's still bearish VAMS. Obviously, it's been grinding at the upper boundary of its probable range for a few weeks now, but it's not yet broken back to at least neutral. So it's still sending a warning signal to investors that we're not out of the woods yet. Maybe there's another catalyst. Maybe we're due for a correction in the broader asset markets before we can see this broader rally. I'm not sure. I don't know what the answer to that is, but it's certainly the fact that that's still bearish. The small cap to mega cap ratio is bearish. It's not making new lows, as I highlight here on the chart on slide 14, but it's still bearish. On slide 15, value to growth ratio is still bearish, but as you can see, it's very clearly put in the bottom. Are we going to break the neutral VAMS in these ratios? Perhaps. I would expect it to happen if we stay in Goldilocks for an extended period of time, which is my initial thought on that. Obviously, that initial thought could be wrong. We're going to update our views as the data changes, but as of today, I do believe Goldilocks has the ability to survive for at least a couple of months, because again, there's nothing really changing from a growth, inflation, or policy perspective that should say we need to go out of Goldilocks between now, or let's call it, I don't know, the end of September. The VIX ratio. So the reason I like looking at this is this thing's pretty consistent in terms of breaking the bearish VAMS whenever you're having a meaningful market correction. And this is going back, as far as you can get the data. Obviously, it's a 3-year chart here. But the fact that it's not breaking out to new highs is telling me, hey, we need to keep dancing, as our buddy Chuck Prince once infamously told us to do. So getting into the wood on the portfolio construction, chopping that on slide 16. Defensives, DEF is the ETF there. Bullish VAMS, not actionable from the perspective of its probable range. Mega cap growth, that's bullish VAMS, not actionable. On slide 17, looking at size, that's bullish VAMS, it's nearly overbought. Real estate, that's bullish VAMS, not actionable. On slide 18, looking at healthcare, that's bullish VAMS, not actionable. Same with Ireland, been grinding at the upper bound of its probable range. But obviously, as you guys know, when a security or asset market breaks to bullish VAMS, it skews the upper boundary of the probable range to create space and scope for the actual likely path of the asset. This is a very unique feature of our process, of our market signaling process, that I don't believe a lot of other investors incorporate. And this is why they're usually late to react to changes in those signals with respect to trading ranges. So hopefully we built a decent process. We have built a decent process. It is working. We're proud of it, and we're grateful that you guys are tuning into it and subscribing. On slide 19, Ethereum, that's bullish VAMS, not actionable. Eurozone, it's actually bullish VAMS, but it's overbought. So we would be buying protection, the easy U to speak, exactly. So this is how we use the process. Obviously, it's a long only portfolio construction, but in the context of managing risk, you obviously want to you cash as an asset when you think you're in a downturn, or you think you're in a market cycle downturn. Buying protection, short dated options, 2-3 week options on things that are overbought. And then obviously you can short. And as I mentioned in the macro scouting report videos, whenever you see those scatter plots from the perspective of our great asset market backtest, look for things. If you want to short stuff, look for things at the bottom right of those charts. Those are the assets with the highest risk relative to the growth inflation policy environment that we've outlined, with the least amount of reward, at least historically, with respect to the grid asset market backtest data that we constructed. On slide 20, sorry. On slide 20, looking at quality, that's bullish VAMS, not actionable. Same setup with low beta, SPLV. On slide 21, crude oil, that's neutral VAMS, not actionable. But materials, that's bullish VAMS, not actionable still. So again, recently broke back out to bullish. That was a decent buy on Tuesday by us. On slide 22, financials, great buy the other week in terms of hedging the upside to duration risk that we highlighted. again, we don't think interest rates are going to break out from here because, again, when we saw I think Q1 was the worst quarter in history for the long end of the bond market. Obviously, DV01 is going to be much higher, there's going to be a lot more duration risk at lower levels of interest rates. In Q1, we were in very aggressive inflation. You had a really meaningful fiscal policy impulse. You obviously had an aggressive acceleration of growth, a very meaningful acceleration in inflation. All that stuff that catalyzed that move in both nominal and real interest rates, starting in February and obviously culminating in March, April, that was in a very different economic environment than the one we have here. So you can talk about the Fed going from 120 billion a month to 110 or 105 billion a month by December or January, but that is a very different economic environment in which they're doing that. In terms of the tapering being this catalyst that's going to get interest rates to 2%. I keep hearing this 2% number, and I'm like, where in the heck is the sell side consensus community getting this number from? We're not going to 2% on the 10-year anytime soon because growth and inflation are decelerating. The Fed can taper, but when they taper into a decelerating economic environment, that is not bullish for interest rates. That's not bearish for bonds. It's not necessarily positive, but again, I think you can see interest rates trade, I don't know. Again, I don't like using targets because it's arbitrary, but let's call it 130 to 150, 140 to 160 on the high end relative to where we've been. Obviously, we hit lows a couple of weeks ago, and we made a pretty formidable double bottom. So obviously, don't think we're going to new lows in the 10-year on the 30-year or the nominal or the real 10-year, which is around one minus 107 at the moment. But again, it's not that we're going to see this big breakout. We don't expect to see a big breakout in interest rates. So pardon me for the tangent. I just wanted to sort of highlight that because I've been getting a lot of questions on that, both in my inbox on Twitter and in recent client meetings. On slide, sticking with slide 22, Barclays Ag, that's bullish VAMS, not actionable. Slide 23, looking at extended duration treasuries, bullish VAMS, not actionable. EM dollar debt, same setup. Looking at slide 24, gold, neutral VAMS, not actionable. We did highlight the capitulation that we saw in the CFTC commitment and futures, commitment of traders report from a net speculative positioning perspective. Huge delta out of gold, minus 2 sigma on a 1-year Z-score basis. That delta historically has been quite positive for gold on a short-term basis. So expect a big rally in gold over the next week or two. IG credit, bullish VAMS, not actionable. Slide 25, looking at 5 to 10-year tips, neutral VAMS, not actionable. 20-year treasuries, TLT, bullish VAMS, not actionable. It's been neutral bullish. It's been a decent amount of vol, but obviously the chart is upward sloping, and we expect that to continue over the intermediate term. But it doesn't necessarily have to make new highs anytime soon because again, you could see this range develop from the perspective of nominal real interest rates. And then lastly on slide 26, looking at the U.S. dollar. Again, it's one of the securities. Remember when we put this on? It was bearish VAMS. Nobody wanted to buy it when we put it on in June, and it was like. Oh my God, you're buying the dollar? No, it's one of the only assets in the world that's going to go up when the Fed starts tapering. So we've seen enough previews of like what the market, when the market's really concerned about what the impact of that ultimately is, this is one of the things that goes up. Now, I ultimately believe that the markets have digested a decent amount of what tapering looks like and it should feel like. And so I don't believe it's the bearish catalyst that we initially thought it was going to be. That everyone thought it was going to be. It's not this sort of boogeyman out there waiting for us to capture us and kidnap us that we thought. It's, to me, I think it's what the reemergence of Goldilocks. So let's start every conversation with what is the dominant market regime? It's Goldilocks. So the reemergence of Goldilocks to me is a signal that asset markets are comfortable with this concept of tapering. And if they're comfortable with the concept of tapering, where is the liquidity going to flow? They're still buying $120 billion of bonds. And oh, by the way, Janet Yellen can't issue any more bonds between September 30th and who knows, the end of October, early part of November. That's going to be very positive for risk assets from a net liquidity perspective. So who knows, you could actually maybe see the dollar trade down a bit in that setup. I'm not sure. I actually don't know the answer to that. What I do know is that the dollar is still neutral from a volatility, just a momentum signal perspective. So obviously continuing to watch that closely. Dollar has a tremendous amount of impact on the commodity assets in our global macro risk matrix. So to the extent it breaks down or breaks out, we could be moving in one direction or another. So obviously keeping our eyes on that, but it's been a good trade thus far. We're happy to keep it in the portfolio construction. So with that, your skipper here, Darius Dale, thank you for tuning in with us. I'm obviously on the road here, and I appreciate you guys watching. Catch you back here next week. Thank you.